Let's talk about investing in gold. What's the real secret to success? Is it all about nailing that perfect moment to buy? Or is it more about the method you use to invest your money? Today, we're going to dig into that exact question. This is the question that keeps so many investors up at night. We're all chasing that perfect moment, right? That magical day when we can buy at the absolute bottom. But is that really where our focus should be? All right, here's how we're going to break this down. First, we'll look at why everyone's so obsessed with perfect timing and check out Gold's seasonal calendar. Then, we're going to flip the script and ask if your strategy matters more. We'll compare two main ways to invest and then pull it all together to help you figure out what works for you. Look, at the end of the day, the obsession with timing the market comes from a really simple place. We all want to get the most bang for our buck. It's that classic idea. Buy low, sell high, get the best value, and please, whatever you do, avoid those painful losses. So if you are trying to time the market, one popular way to do it is to just follow the calendar. See, the demand for gold isn't totally random. It actually follows some pretty predictable patterns, driven by seasons and cultural events happening all over the world. Okay, so check this out. This timeline, which is based on some analysis from Coinbazaar, kind of maps out a typical year for gold. The year kicks off with a post-holiday lull. Prices might level out. Then early summer is usually an off-peak season. But then as we get into late summer and fall, things really start to heat up, building to that peak season when demand, especially from India, just drives the market. And that peak season is a huge deal because it's powered by more than just your average holiday. In India, for example, specific festivals like Akshaya Tritiya, Dhanteras, and Diwali are seen as incredibly lucky times to buy gold, and that creates these massive surges in demand. So, yeah, timing the market based on the calendar is definitely a factor. But what if it's not the most important one? Some financial experts, like the folks over at Morgan Stanley, they actually think we might be asking the wrong question altogether. And this is the big pivot. What if success isn't really about picking a specific date on the calendar? What if it's all about choosing the right way to put your money into the market? This simple question totally shifts the focus from timing to your own personal strategy. And once you start asking how, well, that leads us to two basic strategies for investing. It doesn't matter if it's gold or stocks, it usually boils down to one of these two, either dollar cost averaging or lump sum investing. The difference is pretty simple. On the left, with dollar cost averaging, you invest a little bit at a time, say the same amount every month. On the right, with lump sum investing, you take all the money you have ready to invest and you put it all in at once. So let's talk about dollar cost averaging first. The huge pro here is that it lowers your timing risk. I mean, think about it. If the market dips right after you start, only a small chunk of your money is affected. It's just a smoother ride psychologically. It helps you avoid that awful feeling of putting a huge pile of cash in right before a drop. The downside? Well, if the market just goes up and up, you do miss out on some of those gains along the way. Now for the lump sum approach. The big advantage here is that all of your money is working for you from day one, ready to catch that long-term growth. And, historically, markets do tend to go up over time. But the risk is crystal clear. If you invest right before a big downturn, your entire investment takes a hit, and that can be a really tough hole to climb out of, both financially and emotionally. So, which one actually does better? Well, according to that Morgan Stanley analysis of historical data, lump sum investing often came out just a little bit ahead. As you can see here in this example, it delivered a return that was 0.42% higher per year. Now, that's a pretty small edge, but over the long run, history suggests it's there. So, what do we do with all this? On one hand, you've got the timing argument based on the calendar. On the other, you've got the strategy argument from financial analysis. How do you mush these two ideas together to build a plan that actually works for you? Let's pull it all together. The truth is, there's no single best answer for everyone. If cultural tradition is a big part of why you buy gold, then yeah, market timing makes a lot of sense. If you're all about maximizing your potential returns and you can stomach some serious ups and downs, lump sum investing has that historical edge. But if you're a more cautious investor who just wants to avoid that feeling of regret, dollar cost averaging is a really powerful strategy. But maybe the single most important lesson from all this is that the biggest investment mistake isn't picking the wrong strategy. It's being so paralyzed by the fear of making a mistake that you do nothing at all, leaving your money on the sidelines where it has zero chance to grow. So, at the end of the day, it really comes down to this question. Is your game plan going to be guided by something external, like the calendar? Or is it going to be guided by something internal, like your own personal comfort with risk? Answering that for yourself is the first, and honestly, the most important step you can take.